The RRSP Gross-up Strategy, how to easily contribute 40 to 70% more to your RSP, or even more than that. So wouldn't it be great if you could save a lot more for your future without affecting your day-to-day cash flow? One of the main things you'll learn for your retirement plan is that you need a lot more to retire comfortably than you may have thought. But with all the day-to-day expenses and inflation, it can be difficult to find the money to contribute as much as you'd like to your RSP. So the RSP Gross-up Strategy is a simple strategy that can be a game changer for you. It can enable you to contribute easily 40 to 70% more to your RSP every year. The strategy works if you already expect a refund. So if you contribute monthly to your RSP or have various tax deductions or credits, you probably expect a tax refund. So the RSP Gross-up Strategy can be an absolute life changer if you've got lots of RSP room. Canadians have nearly $1 trillion available contribution room. It's smart to gross up every RSP contribution you make. Okay, what we will learn. So what we're going to learn today is why contribute to your RSP, what is the optimal amount for you to contribute, how contributing 40 to 70% more per year can be life-changing for you. What is the RSP Gross-up Strategy? We'll give you some real-life examples. We'll give you the RSP Gross-up formula, the actual formula for it, pretty simple. How to estimate your tax refund accurately. And also, what is the RSP Catch-up Strategy? And then we're going to look at how to combine the RSP Gross-up and the RSP Catch-up strategies into one overall strategy. It can be really cool that way. So, all right, now your RSP Gross-up strategy, you have three options. You have three options for your tax refund. You can spend it, you can invest it, or you can do the RSP Gross-up strategy, which is the best of the three. So here's how the RSP Gross-up Strategy works. So instead of investing your tax refund when you receive it in March, you contribute a gross-up amount in February that will be refunded by your tax refund. Okay, best way to look at it is with an example. So for example, if you've been contributing $1,000 a month to your RSP and you're in a 40% tax bracket, you should already expect a tax refund of about $5,000. Instead of investing the $5,000 when you receive it in March, you could invest $8,333 in February during RSP season. Use cash or a credit line temporarily, contribute $8,333 in February. In addition to your $1,000 per month, you've contributed $20,833 for that year, which gives you a tax refund of $8,333 to pay you back for your contribution. So this strategy magically means you've contributed $3,333 more. So $3,333 more. So you put that extra amount in, even though you didn't use your cash flow. So it did not affect your cash flow. You can make the RSP contribution from cash or credit line. You get it back 2 months later. Okay, now there's a formula for this. The formula is your expected refund before divided by 1 minus your marginal tax rate, and that equals the gross up. So in the last example, 5,000 was what you expected. 1 minus 40%, 40% is your marginal tax bracket. So basically you're dividing it by 60%, and that gives you the 833. That's how to figure out how much of a top up you can do. And if you do it right, it'll repay you. So with the RSP Gross-up Strategy, you contribute $8,333 in February during RSP season instead of $5,000 tax refund in March, this is a 67% larger contribution. We have just created an extra $3,333 in your RSP and have not used any money from your day-to-day cash flow. The benefits, this may be a simple strategy, but the benefits are huge, especially if you do this every year. Over 30 years, this one little strategy can add up to $1 million to your RSP retirement to your retirement nest egg compared to spending your tax refund, and over 400,000 more compared to contributing your tax refund. So that's huge. Both cases, it's huge. If your figures are larger, it can be even a larger bonus for you. Okay, so now your tax refund. Do you have plans for spending a refund? If not, then the RSP Gross-up Strategy is perfect for you. For many people, though, they want to use it for a trip, home improvement, or to pay off debt. The main reason they contribute to an RSP is to get a tax refund. Now your tax refund may feel like free money, but it's not. It's a loan from the government. Remember, you have to pay it back when you withdraw from your RSP, after you retire. So most importantly, if you spend the refund, will you have enough to retire with the lifestyle that you want? So people that have a retirement plan are much more likely to do an RSP gross-up. One of the biggest benefits of having a retirement plan is that it changes your focus to thinking long-term. You may know how much you have to save to become financially independent. You will know, so you focus on how best to find the money to contribute. It's much easier to use your tax refund effectively than to find an additional $8,333 from your monthly cash flow somehow, right? That'd be about $700 a month. So now, there's a quote, never put dry pasta into your RSP. So this was from Talbot Stevens. This is his advice in a book called The Smart Debt Coach that he wrote about 20 years ago. He compares the smaller dry pasta, so dry pasta, to your after-tax cash, and the larger cooked pasta to your before-tax dollars. So when you gross up your contribution, you're putting your before-tax dollars into your RSP. So never put your dry pasta into RSP. In other words, it's smart to gross up all your RSP contributions every year. Now, estimating your tax refund accurately. The RRSP Gross-up Strategy is purely a tax strategy. So the only risk is estimating it incorrectly. If you estimate a gross-up of $833 and then $8,333, but then your tax refund is only $6,000, you're short the $2,300. So a good estimate includes looking at your income, your total income, including taxable benefits and all your tax deductions. Contributions to a group RSP or pension do not give you a tax refund because you've already withheld less at source. So looking at the expected changes from your last year's tax return can be very helpful. Now, you should also know how your income relates to your tax bracket. For example, you contribute $8,333, but only half of it's in a 40% tax bracket, and the other half pushes you down to the 30% tax bracket. So your tax rate on the $3,333 is lower, so you should estimate a lower gross up. So now we add a lot of value for our full service clients here. So it's one area where you can see the benefit of working for us all in one strategy. So we know all of our clients' finances. We know what their optimal RSP contribution is. We can quite accurately estimate their tax refund. In RSP season, we do financial plan reviews, and often recommend an RSP gross-up. We can take their actual return for last year from our software, our tax software, change all the figures to this year's figures, everything that we expect to be different, so we can accurately calculate the RSP gross-up that should work for them. And by doing the RSP gross-up every year, it's a huge difference. Now, this is the tax brackets here for Ontario for 2023. Now, it's easier to think of these major tax brackets. So if you think of them in these groups, it's much easier to think of it. Just look at which bracket you are in. So now, why should you contribute to your RSP? Does it make sense to focus on larger RSP contributions? You only have so much money. Shouldn't you do some TFSA and some RSP if you can't maximize everything? So now there is a factual method to figure this out. Figuring out mathematically what is best is better for you than just doing some of each. So now RSP or TFSA, the big debate. So TFSA is no tax, but RSP can be either more tax or less tax over your life. It depends on your marginal tax bracket when you contribute compared to what it will be when you withdraw. So now, if your marginal tax bracket is higher today than you expect it to be after retire, then RSP contributions have a tax advantage over TFSAs. If you have a financial plan, you'll know your expected marginal tax bracket after you retire, so you know this for a fact. For example, you contribute today and get a refund of 40%, let it grow for many years, and then withdraw, paying only 20% on it. You've saved 20% on the full balance of your RSP, so it's worthwhile then. So now most people will be in a lower tax bracket after they retire. You can also plan to be in a lower tax bracket. So therefore, for most people, this is the most effective place to save for your retirement. Now, let's talk about the optimal RSP contribution. The optimal RSP contribution is a critical figure to know to get the best use of every dollar. It's a really important financial planning concept. So now it depends on 6 factors. So first is the RSP contribution necessary to achieve your retirement goal. So you need a retirement goal first, how much you have to contribute to get there. If you have a financial plan, you're going to know this amount. Secondly, the contributions necessary to maximize your lifetime RSP room. Now, your lifetime RSP room is your room today plus all the expected new room you expect to get before you retire. So, now, thirdly, how much you can contribute in your current marginal tax bracket. For example, if you're in a 40% marginal tax bracket, how much can you contribute in this bracket and only get 40% back? If you have a lot of RSP contribution room, you may need to lower to include the next lower tax bracket in this strategy. So, fourthly, your current RSP room. Fifthly, your available cash, or how much you can borrow. So now with the RSP Gross-up Strategy, it's the cash you have available plus the amount of gross-up you're going to do. And sixthly, it's your target RSP refund. So with the RSP Gross-up Strategy, you plan to get a refund that's going to offset the contribution that you make. So the optimal amount depends on all those factors, and you got to kind of weigh them and figure out what's the optimal number for you. So now the RSP Catch-up Strategy. So let's talk about what it is. So first, if you have a lot of RSP room, the RSP Catch-up Strategy can be a game changer for you. Contribute it all at once, get a huge jump in your retirement lifestyle. So I talk about the RSP Gross-up. This is the catch-up. So now you don't have to deduct it all in 1 year. You can carry forward as much as you want. If it gives you a significantly larger refund next year or the year after. So every case is unique. It takes creativity to look at how large of a catch-up to do, how much to deduct each year, and how much to carry forward. Best use of your larger tax refunds, and how to fit this in your overall retirement plan. So here's a example of how it works. Note all the pieces involved. Don't worry if you don't understand every detail. Note that the concept of catching up your RSP room with minimal use of your cash flow. Okay, so we talked initially about RSP Gross-up Strategy and how that works. Now I'm also talking about the RSP Catch-up Strategy and how we could put them together. So let's say that you have 200,000 RSP room. You've got lots of room. Now you make a good income, 150,000. So your optimal RSP contribution in your current tax bracket is 50,000. So remember those brackets? You get 40% basically back on the first 50,000 that you contribute, which brings your taxable income down from 150 to 100. So now you get 30,000 per year of new RSP room, which is the maximum, and you have 30,000 cash available to make your contributions. Now note, if you just put your 30,000 in every year, you're just never going to catch up. So, and you're in a high bracket, so it's really worthwhile doing. So what do we do? Now, the principles in this example is your goal is to maximize your RSP contribution and keep it maximized. Your 30,000 per year cash flow can keep it maximized for future years. So you only need the 200,000 for this year. You don't define that amount. Okay. That's principle number one. Number two, you can use your tax refunds to make your higher mortgage payments. Okay. Because you're going to have to come up with the extra money somehow. Okay, so let's look at the steps for this RSP catch-up strategy. So number one, you refinance your mortgage, increase it by 200,000 so you can contribute 200,000 to your RSP. Now your RSP room is maximized. Yes, that's good. Number two, now you deduct 50,000 of it to get a refund of 20,000. That's your 40%, and you carry forward 150,000 of this contribution. So number three, contribute your 30,000 cash flow to your RSP room every year, which you're already doing. For the next 7 years, deduct 50,000 RSP every year. So this is your 30,000 contribution plus 20,000 of your RSP carry forward. So, and then you get a refund of 20,000 each year. Now use the 20,000 tax refund to make your higher mortgage payment. So somewhere in this process, you got to figure out how to make the extra payment. So you to pay off the extra 200,000 on your mortgage in 12 to 13 years by increasing your payment by 20,000 a year. which is about $1,700 a month. So you get your $20,000 a year refund, and that basically covers for making that extra payment. Now, in 8 years, your $150,000 income should rise by more than enough to maintain the higher mortgage payments for 5 more years. So your RSP carry forward deductions last 7 years. That $150,000 you carried forward. After that, your tax refund should only be about $12,000 a year because you're just contributing your ongoing $30,000 a year instead of the $20,000 a year, the tax refund you were getting. So now, net result of all this is you have maximized your RSP room and you've kept it maximized. It doesn't affect your cash flow for the next 7 years, and you can easily manage the last 5 years after that. You retire much more comfortably. So notice what a huge difference this made for you. Without doing this, you'd never have caught up that $200,000 of room. Now you've got it all in and didn't really use up a lot of your cash flow, or nothing for the first 7 years. All right, so that's one strategy. Now let's go to the next level. Let's combine this. Let's combine the RSP catch-up and the RSP gross-up into one strategy. So now you can combine the RSP catch-up and RSP gross-up strategy to be even more effective. Again, every situation is unique. You need creativity to work out the optimal strategy for you. The last example that I gave you wasn't actually the best example, since we would likely not carry forward 150,000 of RSP deductions and deduct them over 7.5 years. So we've contributed them, but we waited over 7 years to deduct it all. It's often worthwhile carrying forward RSP deductions for a larger refund next year, but not too many years. So deducting more now and investing the larger refund might be better than the larger refund next year. So combining the RSP catch-up and RSP gross-up is more efficient as long as you do this RSP gross-up every year. So now here's another example that's going to illustrate all this. Again, note all the pieces involved. Don't worry if you don't understand every detail. Note the concept of combining RSP catch-up and RSP gross-up is more effective. So now the principles behind this example. Now your optimal RSP contribution is $50,000 per year. This is all at the 40% tax bracket. So it's also enough to maximize your RSP room before you retire. So that's the right number for you. Now, it's worthwhile carrying forward RSP deductions for 3 years, but not more. Why is that? So you get a refund of $20,000. That's 40% on the first $50,000 per year you deduct, and only $15,000. That's 30% on the next $50,000. So if you deduct $100,000, you'll get 40% on 50 and 30% on 50. But you can deduct more. Get your $15,000 refund now, invest it to grow, and it should grow to more than 20,000 in 3 to 4 years. So you can the second 50,000, you can get 15,000 now, or you can wait and get 20,000 later. But if you have to wait 4 years or more, I could have just got 15,000 now and invested it. So bottom line, it's worth carrying forward RSP deductions 3 years, but not more. So let's work that into the plan. And with the RSP gross-up strategy, you can contribute $20,000 per year in February every year to be repaid by your tax refund in March. So instead of the last strategy, we were waiting for the refund. Now we're going to do it ahead of time. Okay, so let's do an example and just see how this might work. So this is exactly the same situation as before. You have 200,000 RSP room, plus you get 30,000 a year of new room. You earn 150,000. You have cash flow to contribute 30,000 a year. Now, in the last example we did, we used 20,000 per year of your tax refund for your higher mortgage payments. Instead, we could use your tax refunds for your RSP gross-up every year. With the RSP gross-up, your RSP catch-up is smaller, the lump sum at the beginning. You will need only about 10,000 per year for higher mortgage payments, so you can make the higher payments by reducing your RSP contributions from cash flow from 30,000 to 20,000. So use 20,000 for that, still leaves you 20,000 for RSP. With the RSP gross-up this year, you can borrow 20,000 from your credit line in February to be repaid by your tax refund in March. Okay, so we've got it in ahead of time. So you only need 30,000 to make your optimal 50,000 contribution for this year. Okay, so if you contribute 20,000, so that's this year. So this year, we want to start with a 50,000 contribution, but you're going to immediately do a 20,000 gross up, gross up. So you'll need 30,000. And now, if you contribute 20,000 per year from your cash flow, plus 20,000 every year from the gross up, you need 10,000 more for your optimal RSP contribution to get it up to 50,000. So now we want to plan for this year and 3 more, and that's all. So it means you need 30,000 for this year plus 10,000 per year for 3 more years. So it's only 60,000 is the catch-up number, not 200,000. So that's the big difference. Now, it still maximizes your room over time. I'll show you that in a minute, but you only need 260,000, not 200,000. So now here's all the steps. Number 1, refinance your mortgage to contribute 60,000. So you've only put 60,000 in your mortgage now. Now, contribute 20,000 from a credit line in February for the gross up to be paid by your refund. Okay, so you put 80,000 in total. Now, deduct 50,000 to get a refund of 20,000, and then you carry forward 30,000 of your contributions. Okay, so you contributed 80, you deducted 50, you're carrying 30,000 forward. Now use 10,000 of your cash flow for your higher mortgage payments, and that will pay off that 60,000 in 7 years. Contribute the remaining 20,000 to your RSP room every year. Okay, now contribute 20,000 to your RSP from a credit line in February every year for the gross-up strategy, and tax it to be repaid by your refunds each year. So you should get 4 years of $20,000 tax refunds. So now the next 3 years, you deduct 50,000 per year every year, RSP every year. This is your 20,000 contributions from cash flow, plus 20,000 from the RSP gross up, plus 10,000 of your RSP carry forward, and you get your refund of 20,000 to make it all work. Now, in 4 years, your RSP contribution should be down to from 200,000 to about 90,000. You got rid of most of it. So you contribute 80,000 this year, right? That's 50,000, 30,000, 60,000 from the mortgage plus your 20,000 top up. And then 40,000 a year after that. Now, this 40,000 is 10,000 per year more than the new room. Remember, you want to get 30,000 new room a year. So every year you're doing about 10,000 a year more. Okay. Now, so that's where you've got your RSP room from 200,000 down to 90. And this whole strategy took 3 years. Okay. Now what you could do is repeat the entire strategy after that in 3 years, and that will maximize your RSP room. Okay. Now the result of this is you've reduced your RSP room from 200,000 to 90,000 in the first 3 years. Doing it again in 3 years maximizes your RSP room, and you keep it maximized every year. So, and now it does not affect your cash flow for the next 3 years, and you retire more comfortably. So again, notice the huge difference you get from doing this. So now when you combine the RSP and the gross-up strategies, it is more efficient as long as you do the RSP gross-up every year. You increase your mortgage by 60,000 twice when you compare these instead of 200,000 once, but you still maximize your RSP room. And now the RSP gross-up strategy is a contribution 1 year earlier than contributing the tax refund. So that's why this whole method, the second method became a 6-year process instead of a 7-year process. So, all right, so in summary, the RSP gross-up strategy is a simple way to find 40 to 70% more to contribute to RSP without affecting your daily cash flow. With all your daily expenses, it can be hard to find the money for a proper RSP contribution. Using your tax refund in this way, this effective way, can give you a much more comfortable retirement. It's important to estimate the gross up accurately. Your financial planner may be able to help you with this. We add a lot of value for our clients here, our full service clients. We know all about their finances. We know exactly what their optimal RSP contribution is. We can quite accurately estimate their tax refund. So at RSP season, we do financial plan reviews, which and often recommend an RSP Gross-up Strategy. So we get these much bigger contributions every year for many of our clients. So now, one sharp client pointed out to me that the benefit from this one strategy is significantly more than the entire cost of our financial planning advice over your lifetime. So it's just amazing, if you contribute this much more to your RSP, how much of a difference that will make. So now, people that have a retirement plan are much more likely to do an RSP Gross-up. A retirement plan changes your focus to thinking long term. You know how much you need to save to have the life that you want in the future, so you focus on how to find it. So never, remember the quote, never put dry pasta into your RSP. It's smart to gross up all your RSP contributions every year. The RSP Gross-up Strategy, the RSP Gross-up Strategy can make it much easier to achieve financial independence and live the life that you want. And combining the RSP Gross-up Strategy with the RSP Catch-up Strategy is a great way to catch up lots of past room and get an even bigger benefit. All right, so thanks for listening. What you've learned is why contribute to RSP, what is the optimal amount for you to contribute, how contributing 40 to 70% more can be life-changing, what is the RSP Gross-up Strategy. I gave you some real-life examples. You saw the RSP Gross-up formula, how to estimate your tax refund accurately. And then we talked about the RSP Catch-up Strategy and how to combine the RSP Gross-up and Catch-up strategies. Okay, thanks again for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. I have a blog and a YouTube channel. The blog is at www.edrempel.com. And if you hit contact on there, you can request a free 30-minute consultation if you want to find out whether or not it's worthwhile for us to work together. So please like and subscribe to both the blog and to the YouTube channel. If you do that, all that happens is you get my new articles or videos sent directly to your mailbox every Thursday. Thanks for listening, and see you next week.